Welcome to today's community call / AMA. Here we are joined with Ox Wen Moon. You probably know him from Twitter and also from Umami fame. Umami has undergone a complete overhaul and now has some new and interesting products that I personally want to learn a lot about. Specifically, their single-sided vault exposure. Their single-sided counterparty exposure vaults, if that's the right way to characterize them. So I've had you in here for an AMA, I mean, almost over a year ago, and so much has changed on the Umami side. You guys had like a death and complete rebirth, and I want to learn about that process. So Oxfordman, would you mind introducing yourself, your role at Umami, and then sort of how you guys came back with the vengeance and really took off?
Yeah, sure. So yeah, Steve, first of all, Stephen, thank you very much for having me on, and thank you everyone for just listening to me, I guess. But yeah, so I'm 0x Moon, treasury manager at Umami Finance. Right now I also lead the product and the BD side as well. We're a small team, so I guess everybody's wearing a lot of hats in most DeFi protocols nowadays. Yeah, and you mentioned, obviously, I think you guys had it wasn't actually me. It was because I wasn't actually part of the team.
That was Carnation back then.
Yeah, but see, that's such a long time ago, and Umami has gone through such a transition since those days. And actually, Carnation was the treasury manager at the time, but now it's me. So essentially, to give like an overview, what we do is we provide. Or what we try to do is provide vaults that give you single-sided exposure, because it's, at least from what market research we've done, the simplest and easiest for retail or anybody really to understand, and the most composable to use in the rest of DeFi, but also like within your portfolio, even as a treasury manager, right? Single-sided exposure to certain yield opportunities. But yeah, like the whole idea behind all of our strategies is anything low risk, but also high yielding for that low risk, right? Like the idea is we have a more deeper risk profile than something like Yearn, but not too much deeper, right? Where we're trying to be as lossless as possible with our strategies through whatever that may be. And yeah, so as I said, I'm the treasury manager. I do like these monthly treasury reports. Some people might have read them, of our $5 million treasury. Again, the whole point is like risk management is number one. Risk is really important. We want to make sure we don't blow up, like so many SBF, FTX, whatever have done in the past, and it's just too easy to do so in crypto. So keeping our risks low from a security standpoint, from a smart contract standpoint, from financial standpoint, everything. And yeah, those are the kind of ethos that we kind of lead with. But yeah, I hope that gives a good overview.
Yeah, absolutely. So you're the treasury manager over at Umami. Umami is looking for, I think they're looking for the golden goose that everyone else is looking for, which is relatively low risk to relatively high yield combination, and tapping into the juggernaut on the Arbitrum chain. I mean, Arbitrum has undergone, I guess, a bit of a, not really a facelift, but a renaissance where now many things are building on them. It's not just the GMX chain. Now it's just an L2, right? It's an L2 with interesting opportunities, lower gas fees, composability for a lot of assets. A lot of LSTs moving over there, creating this sort of like LST season over there, which is fantastic. Swell just popped over there. Trader Joe's is having a renaissance. So like, it's good to see Arbitrum become this much more flowering and blooming chain. You guys over there trying to make really nice structured products. And with, I guess, like, again, what I'm most interested in is those reduced delta products that are still exposed to, I guess, what I imagine is the P&L of GMX traders. So let's dive into that. But before we do that, I have a question. Carnation was the treasury manager before you. Is it a requirement at Umami for the treasury manager to have an anime PFP?
Well, I think maybe it's one of those backhanded requirements, because it was never on any form. But I don't know. We are all like big. I think this is all part of the crypto community, right? We're all big women profile pictures and anime profile pictures and all this kind of stuff. So
I have noticed that. I mean, I remember like, well, you guys were the origin of Umami, if I remember correctly, was like this cheeseburger slash anime fork.
Yes, yeah. So that
From
was
way back in the day.
0 to right back. So actually, yeah. I mean, Arbitrum has been around for so long it feels like now, but 0 to was one of the first protocols on Arbitrum. And yeah, it was an fork. That's essentially how we started. Then we rebranded to, I think, Arby's Finance.
That's
And
right.
then after that, there was another rebrand to Umami Finance. And all three of those products kind of did different things. 0 to was like an fork. Arby's Finance was a like an auto compounder for Arbitrum, and then now Umami is sort of the structured products that are a little bit more sophisticated. And I guess like the protocol has just always adapted to the environment that DeFi has been, and what users really need. And I think especially at this point in the bear market, users are a lot more savvy, and especially users on Arbitrum are a lot more savvy
Yes.
to things like impermanent loss, to things like any real risks that there is. So it's really important, I think, where we position ourselves, and especially with Arbitrum, and essentially our user base as well, right?
Yeah, 100%. I mean, at the time, it was definitely a good thing to be an fork, and then transitioning into something building on top of GMX, and then transitioning to something more robust, building on top of GMX with different, more unique exposures. You guys are well positioned. But let's check out the protocol, right? So this is what I want to talk about. But if there's something before this, like I just want to jump into what I'm interested in. I know there's probably way more to talk about though. So
let's do it. Yeah.
All right, awesome. So I am interested in these vaults, right? Because these vaults, they advertise ETH. I mean, the link yield especially, it's incredibly hard to get link yield. It's incredibly hard to get uni yield. So these two things are probably remarkably compelling to people who are in link and uni. And then, of course, wrap Bitcoin, right? Any Bitcoin yield is going to be difficult. Some people can go around DeFi, can act very dynamically, can probably find an ETH yield at or around 14-15%, especially if they're willing to sort of like be very mercenary with their farming. But these three, you're probably not going to find very many other places. So I want to understand these vaults because from my understanding, if you go to like GMX V2, what you'll see is what are effectively LPs, right? Wrap Bitcoin, USDC, Link USDC, WETH USDC, Uni USDC. And each one of these can experience something similar to impermanent loss by virtue of the rebalancing of those counterparty vaults. So here you've removed that, I guess, pseudo impermanent loss in some way. And I'd love to learn how that works and what additional exposures the user might have or might not have by entering into these vaults.
Yeah,
I also noticed they're all at capacity, so we can't enter them today. So also, when is the cap increasing? Is another question.
So first, they're all at capacity apart from USDC. Right now, given the market conditions, we're just waiting for some more USDC deposits to come in, and then we're going to just lift the cap of all the vaults simultaneously. I think that's probably the best way to do it. But before I do answer your question, let me quickly give, like, for anybody who doesn't really know what the vaults do, very quick overview. I think the name of the vaults, that says it perfectly. They're deconstructed GLP vaults. And the idea behind that is that GLP itself is a basket of assets. I'm sure everybody here is familiar with GLP, so I'm not going to go into too much detail with it. But yeah, GLP has BTC, ETH, Uni, Link, etc., etc. Tons of assets. And the problem really for any user that's trying to LP in GLP is that although it gives you, number one, a good yield, and number two, like access to trader P&L, which, on average traders are losing, you want to keep that kind of both of those things. But you also, if you're holding ETH, let's say you have your portfolio, you're an ETH maxi, you're holding ETH, you want to keep your exposure to ETH, and you can't trust that when you're holding GLP, you're going to be, maintaining your exposure to that ETH. ETH might go up, and GLP might be underexposed to ETH from what you thought it was. Maybe you thought it was 50-50, but actually it was 40-60. So the problem really becomes that you're facing these sort of losses that, you know, just come from this asset that you don't really know what you're truly holding. What we do instead is make it super, super simple. You want USDC, you put your USDC in the GLP USDC vault on Umami. That will maintain your exposure to your USDC while farming the trader P&L and the GLP APR. Now, to explain your question, right, about like this impermanent loss thing, the first thing to really understand is that, like, what is impermanent loss, right? And impermanent loss is a sort of convex payoff function that kind of, with price, especially like if we're looking at a UniV2 LP, which is the perfect place to kind of think about it. It's the loss that you face where, as price moves, you're selling or buying at a lower price. Let's say that ETH is at 1800. ETH moves to 1900. All the time while it's moving from 1800 to 1900 through your LP, you're going to be selling underneath the current price, right? And that difference is essentially your impermanent loss. In like traditional finance, it's just known as gamma, right? It's the closest thing we have, because obviously, you know, I guess impermanent losses sort of, right, people call it different things, but yeah, in traditional finance we have this thing, it's called gamma. Options have the same sort of payoff problem, but perpetuals don't, right? Perpetuals are linear instruments. Perpetuals don't have this sort of gamma risk. They only have like deltas. So anyway, the point is that, you know, with UniV2 LPs, the reason you face impermanent loss is because of arbitrage, right? You face this loss from, you know, if the price in the market moves and your price in your pool is lagging, you're going to be selling or buying whatever asset at a stale quote, at a stale price. GLP has a method by, like, you know, they use these trailing oracles that mean they're always quoting the market price. So there's never really you're never really facing impermanent loss with GLP. Instead, you're facing this this other thing that's, let's say, similar to impermanent loss, but in a very important way, it's not the same. And that's because it doesn't have the same relationship to the underlying price, right? And so that, as you said, right, this thing that we can call, what we call this effect is called delta drift, right? It's the drift in the deltas of the basket as a result of traders, you know, selling or buying assets through GLP, minting and burning assets through GLP, or any other thing that essentially creates this difference in your deltas.
And the thing is, by delta, you mean like the ratio between the volatile asset and the stable asset on any of these pools? So you guys use the V2 pools, is that correct? Or do you use GLP?
So by delta, I really mean any delta for any of these assets, right? So with ETH, the sum of it is some of GLP is exposed to ETH, some of it is exposed to BTC. So you have deltas to BTC, and you have deltas to ETH, and you have a deltas to Link. You know what I mean?
Yes. So I guess like one of the questions I had was, are you using GLP V2? And it seems like the answer is no. You're still using GLP proper. So
the GLP V2 product that we are actually, it's under construction right now. Actually, let me quickly go back. The whole thing that we've built is essentially an infrastructure layer rather than being, you know, dedicated to GLP. The idea of what we built is any yield component that can be split up into different single-sided exposures, we can do that. So all we really need to do now is change that yield component from GLP, which is what the current vaults are, into GMX V2. And GMX V2, I think, has an even better value proposition for us because it is like already sort of fragmented liquidity, and we can sort of bring that back together and give you know, benefit GMX as well as benefiting users. One sec, let me turn my notifications off. But yeah, so we can benefit users. Right now, that's under construction. There is some not technical difficulties, but technical changes between how they use the Chainlink oracles in V1 and V2 that we are just upgrading, which is why it's taking it's going to take maybe 1 or 2 months and then an audit after that. But yeah, those vaults are under construction, and they will work in a very similar way to these current vaults, where you will have GMX V2 USDC vault, WETH vault. For now, we're going to be keeping it as USDC and WETH because the BTC, the Link, the Uni, they don't really have as many avenues to actually put them. But both USDC and WETH have many markets where you can actually put them. So that's what we're going to be doing for the V2 vaults.
So effectively, the V2 vaults are going to be doing something similar to what the V1 vaults are doing, where it's isolating exposure to any one of these assets and producing some sort of yield. Now, with these vaults, they are all exposed to trader P&L. But is it specifically the trader P&L of those assets? Like, let's say you enter in the WBTC vault. Are you only exposed to the P&L of users trading BTC, or are you exposed to the P&L of GLP as a whole?
Great question. So the way that this works differently in both GMX V1 and V2, so I'll explain them differently. But for V1, the way that the kind of trader P&L is actually balanced through the pool is with like a mechanism that essentially shares it around all of the vaults. So yes, in a sense, all vaults will face the same trader P&L, USDC, WETH, BTC, Link, Uni. And I think that is honestly the best way to kind of do this because especially if the asset that's underneath, the underlying asset, the GLP, is sharing all of the exposures, there's not really a clean way to split that up if certain traders are losing more on WBTC and Link or whatever. And it is just easier and I think easier for people to understand if they understand that you're exposed to GLP from every other perspective apart from the deltas. Your delta is the same, and apart from that, you're getting the yield, you're getting the trader exposure. That's not the same in V2. V2 has these isolated markets where also the trader P&L is isolated. Our vaults will be able to sort of group those assets together to give you the best yield. But at the same time, we can have the ability to isolate that trader P&L for you. So in those cases, when we do make those vaults and we do add, because we will eventually add the other assets too, but it really depends on what markets GMX creates. But yeah, you won't be facing, let's say, Doge trader P&L if you have a BTC deposit, if that makes sense.
Yeah, absolutely. So you're saying V1, the P&L is effectively socialized. In V2, it'll be isolated. Now, a question that I have related to that is you have these different APRs for the BTC, Uni, WETH, and Link vault, as well as the USDC vault. What makes these APRs differentiated? So if the P&Ls are socialized, why are the APRs so dramatically different for each asset?
Again, great question. So the reason for this is twofold, right? Number one is because of the investment that each vault takes into GLP itself. So essentially, let me kind of explain the underlying mechanics really quickly. But essentially what we do is that each of the vaults wants their exposure in their own asset, but they all, on the underlying side, have exposure to all of the assets, right? Because GLP has exposure to everything. So let's say that you want exposure to USDC and I want exposure to BTC. Since we both have a bit of exposure to both, we can trade our exposures between ourselves. But since we can do that in this way, and we already know each other, I already know you hold GLP, you already know I hold GLP, we don't need any collateral. I don't need to charge you anything for the trade because I'm helping you, you're helping me. There's no funding, there's no opening or closing costs, there's no rebalancing, and there's no reason for you to hold any excess collateral either. we see each other's GLP, and we can use that as collateral, if that makes sense. And that's the isolated vault. I mean, the isolated, what we call it, internal netting. That basically means that compared to any competitor or even the V1, when you did the podcast with Carnation, I think at that time, the V1 version of these vaults were being created. That time it had a much higher cost of rebalancing and cost of hedging that we've kind of eliminated at this point because of the internal netting algorithm. What that just means, though, is that there's a sort of algorithm in the side of the vault where it doesn't make sense to invest over allocated vaults all the way if GLP is paying a low APR. And since you can see some of the vaults like USDC are less allocated versus the rest of the vaults, GLP, the USDC vault is essentially the one that has the highest APR because of this reason, right? It's the one that's helping. In a way, you can think about it like this: all the USDC deposits are helping everybody else, all the other deposits, get a load of free trades. So in return, that vault gets the highest APR because that's the one that we're trying to incentivize for more people to deposit, if that kind of makes sense. Link and Uni are actually over allocated compared to GLP. So that's why they have the lowest APR. That's the one reason, but go ahead, yeah.
Okay. So and please forgive my slow learning here. You're saying that, let's just say GLP is 50% USDC roughly. And right now you guys have 60% a basket of volatile assets. So because you want to balance and have roughly that 50% GLP composition, there is more of the yield going towards the GLP USDC vault. Is that correct?
Perfectly put. But the reason more of the yield goes to the GLP USDC vault is actually because the overall APR that the vault pays is a function of both the yield that is generated on GLP and, of course, the trader P&L that's generated, minus whatever costs it takes to hedge. But since the USDC vault is the most underallocated, it's the one that has all of its trades for free, right? In the same vein as you just said, right? Because it is underallocated, it's giving everybody free trades somewhat, and it's obviously giving itself free trades.
Can you explain what you mean by giving free trades? I'm not sure I get this concept.
Okay. So internal netting, let me try and explain it from the top. Essentially what it means is we have all these deposits. All of these deposits need to place trades to get delta neutral or delta 1 to whatever asset they have. So the ETH vault needs to short all the assets in GLP, but it also needs to long ETH, right? The same goes for the BTC vault. The BTC vault needs to short all the other assets because it doesn't want exposure to them, but it needs to long WBTC so that you have one.
Is it like, let's just say a BTC is 28% of GLP. I think it's like 25%, but like let's just say 30%. Let me see it really easy. Let's just say BTC is 30% of GLP. So when you enter, what's effectively happening is that WBTC is purchasing GLP, but now you need to long 30%, or no, you need to long the rest of the 70%, and you need to short the rest of that as well.
Yes. You need to short all the rest, and then you need to long.
Okay, 70%. Like what you need to long the rest of the exposures, 70%.
Yes. Technically, you need to short all the exposure apart from USDC and its own assets. So you need to short around about 30-40%, and then you need to long the other 70%. Yes.
Now, why don't you? You're right. You don't need to short. I got it. Yes.
But here is the point, right? The point is that since these guys are placing trades in opposite directions, right? If you look at just, let's say, the USDC and the ETH vault, the USDC vault is trying to short ETH, but the ETH vault is trying to long ETH, right? So what we do is we place those trades against each other. We make the vaults sort of counterparties to each other for some of those trades, right? That means that these vaults can place these trades 100% synthetically between them because all they have to do is settle the P&L after the trade is placed, or during whatever the life of this trade. And there's no need for any collateral, and there's also no need for the vaults to charge each other. That's the really important bit,
So
right? It's
these vaults are counterparty to each other rather than being counterparty on GMX.
They are also so. The thing about that thing is that you cannot net everything, right? Not all the exposures will be able to be traded against each other. There's some exposure, especially since the USDC vault is under allocated in this moment. Since it's under allocated, it's able to give everybody all of these internal trades and then be completely flat itself. But the WETH vault still needs to find somewhere else to long its ETH.
Right.
So it will go. We do not pretend we're in an ideal world, right? We do not pretend that the TVLs are perfect. We know exactly our exposure. Anything that we don't get internally and we don't get for free, we then go and place that externally. So we make sure 100% of the time, each of the vaults have the exact correct delta, and we're not pretending we're in some ideal world.
Now, are those placed on GMX? Or are those placed on some other place where maybe you get better funding or has deeper liquidity? Where are the... Yep, go ahead.
Great question again. So we have built this essentially a perp router. Well, not a perp router, let's just say a trade router, where the router essentially has plugins that we can add for different protocols. And the two current ones that we have is Aave and GMX. And we can add more, and we are thinking of adding more. The ones that we're thinking of adding right now is Vertex and Orderly, but we're still like doing due diligence and all that kind of good stuff. But yeah, once you have these, essentially the router goes, okay, first and foremost, let me maximize trading between the vaults, right? So it will say USDC vault, you want to short ETH, ETH vault, you want to long ETH. Let's pair you two together. Now, any excess trades that still need to be placed, it will look through all of those and it will say what is the best liquidity, what is essentially the best funding, and what is the best execution cost that I'm going to get on this. And usually right now it's GMX over Aave, just because Aave is a sort of spot market. It's nice to have it because of liquidity concerns. But right now, since GMX has the liquidity, we can place those trades there for relatively cheaply. And so yeah, we're placing those trades on GMX itself. And obviously the reason that we've chosen GMX as the first avenue is because it adds the least, I guess,
additional exposure.
Yeah, exactly. Perfectly said. Yeah.
Yeah, because the users are already okay with being exposed to GMX. And then Aave is Aave. So thinking about other things like Mux, where you already have this sort of perp router. Of course, like you're always paying funding, which is kind of a bummer there. They don't allow you to aggregate the funding that works in your favor. This is kind of cool. Hopefully that gets built out, so maybe you could even benefit from those positions in that way. So the APR is coming from GLP's trading P&L, but right now GLP's trading P&L is something like 3%. How are the APRs on Umami so high?
Again, another perfect question, right? So the sort of equation that determines the APR for us is a mixture of three main things. A couple of other things, but let's stick with the three main things. One is obviously the GLP's APR itself. The other is, that's a positive. The other is the rebalancing costs, or the cost to hedge. That's the negative, right? And then the final thing is the trader P&L. And the trader P&L right now is making up. So you add essentially the 3% that you're getting from GLP itself. The trader P&L has been somewhat negative since it's not been like even crazily negative, but it's been somewhat negative since we've launched 3 months ago. And obviously we are trying to show like the longest span of our APRs that we have. So, we're doing since inception.
Yes.
But we also have backtest for like another year prior to that. And still, the results show the same thing. The fees right now are almost negligible because our investment is like minute. We're right now we're hedging. I think we only have $40,000 of the entire 4 million in any sort of hedges, including like just even collateral. So it's an extremely efficient strategy at the moment, or it's trying to be, because the APRs are so low. It's essentially saying, since we only have a 2% edge or 3% edge, we're going to try and keep the trading fees, I mean, the costs for this strategy almost at zero. We still have this extra 3%, and then the other, in this case, 14 to 3, you're getting like an extra 11% from trader P&L. The final thing I'll mention is if you see this arrow that points from 14 to 16% with this sort of like electricity symbol, this is the boosted vault that we have. So the way that our vault works is it sort of works better when everybody sort of deposits together, right? It's a sort of what I say positive return scale, where if you deposit USDC and I deposit ETH, we're both helping each other because we're giving each other those free internal trades, right? And the boost essentially just allows you to signal that you want to stay in the vault for a longer time. The normal 14% is 100% liquid. If you deposit, you can withdraw immediately after if you so choose. So there's no lockup, right? That's a really important part. But the liquid vault allows you, the boosted vault allows you to lock your deposit for 14 days, quite a short time, but you get a boosted yield compared to everybody else. Where the boost comes from is essentially a small amount of the yield for the entire vault is taken away and given only to the boosted section. So in this vault, I think...
So this reminds me of like the senior and junior tranche sort of mechanism where you have people who are playing counterparty to each other and therefore they're getting some additional portion of the overall yield. Here it says you have to wait for an undefined amount of days. You're saying 14 days. Is 14 days the maximum or is 14 days a standard and it is defined?
Okay, so sorry, I didn't catch this before. I should talk to the UI guys. It's 14. It's 14.
Okay. Oh, cool. Well, that's even better, right? Because undefined means like, okay, well, maybe it takes like 60 days to unwind the position because we have some whales in there.
Locked. No. It's completely locked. As soon as you click withdraw from the boosted vault, it will. 14 days later, you'll be able to get out.
Okay, cool. I like that. Okay, so boost, like I was thinking boost was going to be some sort of mechanism where you had to hold like the Umami token or have like vote escrow this or something to get that boost. You're saying it really is just a signaling to be willing to wait a longer time so that your funds can play counterparty for everyone else without having to dynamically withdraw, which I know is an issue, especially when those funds are trying to be used.
Yeah, exactly. You've put it perfectly, right? I think a lot of the time in DeFi, protocols, like we already have a way to incentivize our token. We already have some value going to our token. And the way that we do that is through our 2 and 20 management and performance fee. And that goes to the marinade. Which is, where you stake your Umami tokens. So, we don't do all this sort of fugazi, let's try and add utility here, let's try and add utility there. But it's actually like kind of fake utility. It's everything that we try to do is completely real yield, right? Like we still keep that ethos where like even the boost, none of that comes from even Umami incentivization. You don't have to lock any Umami. If you really want, you could touch the vault products, and this is what we would really like to see. Somebody could come, not even know what the Umami token is, and still enjoy these 14, 16% yields on USDC without touching Umami ever. You know what I mean?
Yes, which is a big difference from, like I won't say competitors, but other protocols on the Arbitrum network. Maybe some money markets that require you to have a ridiculous amount of their token in order to realize any yields at all on those protocols. We're not going to name names or point elbows, but
I know exactly.
Right. So, all right. So this is pretty fascinating. Let's talk about fees, right? So we've talked about all the benefits, all the cool stuff, but let's get down to brass tacks. There are some fees here. I'm seeing deposit withdrawal fee. That's deposit and withdrawal. So if you deposit $100, you will effectively be entering with $99.25. And then if you were to exit immediately after that, you'd be leaving with like 98.16. Is that accurate? Like, let's just say like you deposit and withdraw in 5 minutes. You'd be hit with that twice.
So the important thing to understand is we do not charge that deposit and withdrawal fee. The problem is obviously GLP itself has this deposit and withdrawal fee that's charged. We charge the deposit and withdrawal fee to pay for that GLP mint fee, essentially. And also technically from the perp side, the perp has a sort of fee as well. If we don't charge that, essentially what's going to happen is as people deposit and withdraw, the vault gets drained, right? And the reason it's 0.75 and not like whatever GLP is charging is just to prevent any of those sort of attack vectors. But any excess of that yield, so let's say right now you deposit, it's going to charge you 0.75 and then 0.21 is what you're going to get back. Is what it's going to cost. The excess comes into an escrow contract, and then over, I believe, 30 days, I think it's 30 days. Over 30 days, that that excess will be streamed back to your deposit. Does that make sense?
Yeah, it does. Wow, that's a pretty complex mechanism that you wouldn't typically expect to see.
Important. I know. I wish it was kind of easier, but the problem is just to make sure there's like no attack vectors here, and there's no way that you can spoof the fee on their side and come deposit with us. We kind of have to charge essentially the maximum fee that's possible, which is 0.75, and then give you back the excess rather than just giving you charging you a normal amount. And then
it's just a regular 220, right? So 2% effectively is similar to a management fee. I know. I think legally we're not allowed to call it a management fee. And then yield is this is effectively a performance fee.
Yes, exactly. Performance and management fee, 2 and 20. Very standard, I think, for DeFi, and also it's very standard for any fund or anything really, right?
Okay, cool. So then if we go over to Marinate, we look at this 5% APR is only coming from the portion of the 2 and 20. It's not coming out of the GLP yield.
Well, technically the 2 and 20 does come from the GLP yield. Right?
Sure, yeah. But it's not coming from like off of the top GLP yield. No. It's coming from the fees taken from the vault depositors.
That's correct, yeah. Okay. And then the other thing I will say is also, Marinate doesn't just enjoy the vault fees that are generated. It also enjoys the treasury that we have generates like some sort of APR. And I think since our previous treasury report, or at least the last few months, it's been earning a rough 12% APR on the treasury. The Marinate enjoys half of that as well. So that's also extra yield on top.
Okay, I would go to your Twitter to look for any treasury reports, but your Twitter is a bit spicy. So I will let other people go and look for the treasury reports. Is there an easy way to find those in a centralized location?
Yeah, of course. The Medium, if you just go back to the Umami finance website, just go to the Medium. It's at the bottom. Yeah, like monthly treasury report.
There we go. Okay, cool. So you can look at these, get a sense of what the treasury is doing. Now, the treasury is it cross-chain or is it only on Arbitrum? What's the thesis of the treasury? How does that work?
The treasury right now is only on Arbitrum, but again, we are more than happy to actually move. It really just has been that there's no real reason or let's say any reason for us to take any more added risks on that.
Now,
right now, the whole thesis is essentially keep it simple and like obviously the worst thing to do would be like to blow up the treasury on like Maple Finance or something crazy like that, right? So we keep the risks low, and when we do take risks, we take them at least either correlated or we've done proper due diligence on whatever protocol. Some of our funds now is on vendor finance, and that's another one of the guys that trying to do something that's positive sum to all token holders and adding value to them. And then most of the actual active management of the treasury just involves our protocol and liquidity, right? So we have $5 million. Half of the reason for that $5 million is to provide liquidity for the token and not have those incentives, right? Again, most protocols have to incentivize their own liquidity. We don't have to do that. We simply have our funds that we can put into the liquidity pools and do that essentially ourselves, right? And we actively manage that. That's mostly where our yield is coming from right now.
So is that like a Uni v3 position that you guys are actively managing, like doing range optimization?
Yes, that's correct. Some Uni v3, some are on like even Camelot right now.
Sure.
And I think some are on even Kyber Swap. But yeah, it's Uni v3 style mostly, again, because capital efficiency is out of the roof. And I'm a big v3 proponent myself, so yeah, that's great.
That's really cool. Now, the next question that comes with this treasury grows by virtue of the fees on the platform, or does this treasury also have some other way to absorb TVO?
Yeah, so it grows because of obviously the yield that the treasury itself generates,
right.
But also the fees that we charge on the deposits. 50% of those fees go straight to the treasury. 50% of those go straight to Marinate. That's the entire theme here, essentially. Half of it helps grow the entire protocol. Half of it helps give this sort of quote unquote dividend to token holders.
Okay, so just so I understand the last part, when the treasury grows, I'm assuming that growth is in terms of additional assets, not in terms of like fiat value. Because let's just say Arbitrum increased some substantial amount. Would you sell the Arbitrum to give it to token holders, or are you only counting yield here?
No, wait. So if you scroll up a little bit, somewhere here, yeah, almost there. Yeah, this is the gross yield that we kind of measure, and we give half of this to the stakers.
Okay, and the gross yield is only yield, not asset appreciation of value, right?
No.
No, as in no, it's not just yield, or no, as in yes, you're right, it's not just yield.
It's not asset appreciation.
So okay, yeah, that's got it. Yield, yeah. Okay, cool. And so half of that goes to Umami stakers in the Marinate contract. Got it. All right, I think I've learned about as much as I can from this front end, which is pretty impressive. So you also have Exchange. I don't think this is like a heavily used product. If I understand correctly, you have a bridge. Is there any benefit to the Umami bridge swap and on-ramp that would be notable versus its competitors?
No. To be honest, this is sort of a legacy product. Obviously, use it if you want, but it doesn't really give us anything. I don't think it's literally just socket, right? It's just a front end.
Got it. Yeah, I was wondering about that. So cool. I feel like I've asked all my questions. Are there any additional pieces of information, upcoming news, alpha, that you would like for us to know?
Yeah, so two things I quickly want to touch on is number one, like the entire ethos, especially behind what I build in DeFi, is that I don't want to put I don't want to build products that have no reason to be on chain. I think a lot of DeFi sometimes says, let's put XYZ that's already in TradFi or already in a different market on chain. You ask them why, and there's almost no real reason to do so. The whole thing behind our vaults right now is that we are leveraging essentially the technology that is the blockchain, but in a way that is allowing for these pool deposits to allow people to signal, essentially, these vault deposits to signal to each other that they actually want to trade with each other in a sort of OTC way, right? That's the entire idea behind the internal hedging. It's that you can actually like finance. A lot of the time, people say it's PvP, it's zero sum, but there is ways that you can even though it is PvP, even though it is zero sum, there is ways that I can help you and you can help me at the same time, right? And so the entire ethos behind it is to be like as Pareto optimal as possible, and not just provide a lot of the time, especially with RBs, auto compounders provide a very low value proposition, right? Technically, you can do that same auto compounding yourself. Obviously, it's easier for you, but that's not what we do. What we try to do is, and I've talked to funds that cannot do what we do, and the reason is because even though they can hedge on centralized exchanges, and centralized exchanges are genuinely cheaper than, or like most of the time cheaper than on-chain avenues, nobody on any of these market makers, none of these market makers can have free trades. None of these market makers can have completely liquidation-free perpetuals. None of these market makers can have the ability to use no real collateral in any of these trades. They need to have money locked up on decentralized exchanges as well as doing this GLP trade on the side. They need to rebalance this all the time. They need to pay funding on that side. It's a pain on all fronts. And so we try to provide something that's better than that. And the other final thing I'll say is, actually, do you want to comment on any of that before I move on?
Well, we do have some questions. So one, I appreciate you saying all that. I do think there's good product market fit here. It's not a shame, but it's a shame that, well, I guess it is a shame that the GLP USDC vault is not filling up as quickly to allow for more WETH Link BTC and UD deposits. What's also interesting is in the depths of the bear market, we saw so many stablecoin products just, absolutely killing it with 8% APR. And now you have, I don't even know what market you'd consider us in. Choppy crab right now, maybe bearish crab. And you're offering 14% and still not able to reach a roughly, what is this, $2.4 million capacity. Yeah. It's interesting. It's fascinating with this APR.
Well, I think it comes back to what you and to be honest, I actually thought the other way around, right? When I was first making these, I thought USDC would be the most demanded, and the reason is because the USDC, from a pure Sharpe ratio point of view, the USDC vault offers the biggest Sharpe ratio, right? Because it is the delta neutral vault. But I think what you said at the start perfectly touches on it. There is nowhere you can get, even if the Link APR is only 5% on the boosted vault, compared to 14% on the USDC even liquid vault. There's no way you can get Link.
Right.
There's no way you can get Uni yield, and there's very, very little places you can get BTC yield. So that's really why we're seeing such a big demand for all those three. And until like last week, even the WETH vault wasn't full, and those two were essentially the two laggers. So yeah, I think we are seeing that, but I think that will change because of the next thing that I'm kind of bringing up, which is the other great thing about having things on chain is that you have these DeFi logos, right? And so we are in close contact. I think you've talked about Dolomite before, right? I think you're a big fan of them.
Yes, I am.
Yeah, so we are in close contact with them, and they will be launching their integration very soon. And
wait, are you saying you're gonna have some composable vaults here?
Yeah.
Okay, I was putting two together. I was like, okay, yeah, I like Dolomite. I like you guys. What are your? Oh, that's what you're gonna do. Yeah, that's super exciting. So, I love Dolomite. Everyone knows I love Dolomite, but I will always, give everyone a grain of salt and say Dolomite is a small money market with novel type infrastructure. Please diligence them accordingly. Don't ape your whole portfolio in, right? We all know what happened to Euler. I know they hate when I bring up Euler because they're like, but Euler had a piece of unaudited code. It wasn't unaudited. It was just audited by a single person. Nevertheless, like that integration is super cool. Very excited for you guys. I was going to say, this APR is technically very competitive with like JUSDC. Why don't you guys go to Dolomite? But now you're already planning on doing that. So that's really cool. Now we just need these caps to get lifted. I will say there is like technically it looks like there's almost 10 ETH in the WETH vault. There's negative 0.1. I don't know how that happened. Negative 0.1 capacity in the oh, that's cool. And there's even a little bit in these two. So there is, some small room for some depositors here. The USDC vault, once that gets composability, that's going to be really, really fascinating because if I remember correctly, Dolomite has an interest rate on USDC around 3 to 4%. So, I anticipate that will fill this vault quickly and hopefully put some additional demand into this vault.
Yeah, absolutely. So yeah,
do you know what the timeline is for
that? I think my devs are talking to Corey like about the entire thing right now. So I do not think it's very far away at all. I think end of month we'll see it, but
end of month, that's 8 days from now. Well, actually, I don't know how many days each month has. It's one thing I never learned. In fact, I didn't know my days in order until I was like well into high school. Don't judge me. 30 days. Okay, I was right. 8 more days.
Yeah.
That's fantastic. Cool. All right. Well, that's exciting. I try not to get hyped about stuff, so that, want to be as objective here. But when I hear composable vaults with nice APRs, especially stablecoin ones that I can take to money markets and leverage, I get a little bit excited. Talk to me about, let's go to the user questions first, the community questions. First one, when do we expect to see new vaults? I'm imagining, I don't know what the new vaults would look like, but I think he means the V2 vaults. What is the timeline for new vaults?
So we haven't released anything publicly on timelines, and I am, as always, because you never know on dev timelines, trying to be conservative. But I think we are a very short amount of months away from this. I guess it depends on sort of stuff like audits and all that. But everything going well, I think it's not going to be too far away at all.
Let's say
Definitely
Q1 next year.
Yeah, let's say that very conservatively, but I do think we will get there before that. So
okay, love to hear it. Next one, this one's gonna be kind of hard. They see Umami APR increasing slowly. Will APRs be up only forever? I don't think that's a question, but what is the reason for APRs increasing as of late? Is it just trader P&L, and do we anticipate this trend to continue?
So actually, recently they've gone down, at least since Singapore, and that's because trader P&L has sort of been very choppy these last few weeks, as the market has, I guess. Right, traders can't win and traders can't really lose if the market isn't going up or down. But yeah, so I think it was at one point just a few days ago, it was like at 30% APR since inception, and that's
why can't I click APR? Is there a reason why this is?
Because the APR graph doesn't actually make that much sense. I don't know why. Again, I don't know why it's on the UI, because the APR graph is sort of like a trailing EMA, even, I guess you could call it, because the APR is calculated based on the past 30 days, but each point on that graph is also, one of those points, if you kind of get what I mean. So it's a weird graph. PPS is much smarter and much more intuitive to just show. So we've kept it as PPS.
Right. If you have a share price, you can annualize that if you want to, but also it helps. Yeah. Cool. Yeah. Love it. So I think we have a couple more questions. We have 3 minutes left. Future utility for Umami tokens. Do we have any future utility for the tokens?
So right now, again, the whole point of Umami is trying to build a product that is revenue generating, and then that revenue being passed on to Umami, not as some sort of like degen, let's do some VE tokenomics, blah, blah, blah. So with nothing like that is planned at the moment. The whole idea, though, is that one thing to keep in mind, obviously, is everything we do is essentially to drive value back to token holders, right? Including like all these vault deposits, including everything that we do. So it's always in the top of our mind, but there's no don't expect any degen tokenomics, weird ass this, that. We try to keep it as simple as possible so any user can be onboarded. But yeah, there's definitely value coming, I think. And you can do the math behind that for sure. Oh, actually, the last thing I'll say is also the token is sort of trading below RFV right now, which is great for the treasury, right? Because the treasury can essentially just keep buying these tokens back below RFV, returning value to each holder, each remaining holder.
What do you mean by RFV here?
So the treasury is $5 million or whatever it is, and RFV is risk-free value. So essentially the value that each token has, the claim that each token has on the treasury.
I was going to ask this. So the Umami token can be redeemed for a portion of the treasury?
So it cannot be redeemed right now. Obviously with a vote it could be, but right now the great thing is since we do buybacks through LPs, we don't actually push the price when we're doing any of these buybacks. We can just keep on accumulating. So as long as the price keeps staying in its range, we are going to be accumulating for a long time. And I think the last treasury report shows it. And even this month so far, we've accumulated a lot of tokens. So yeah, just value going back to holders every single time we do that, essentially.
All right. That's very cool. I don't know if I'd call it risk-free though, because there's like a potential that there is not redeemability, but I do like that you guys are doing maintaining the RFV.
Sorry,
okay.
RFV is just a word that's,
yeah.
I mean, yeah.
I know what you mean. It's like
nothing is risk-free. That's a very
Right.
important thing. Yeah.
Okay. Well, we do have one more question, but we don't have time for it. So Don Sylvester, I will try to get your answer to you in another way. But OX Wenmoon, or 0x, sorry, 0x Wenmoon. Thank you so much for joining. This was phenomenal, fantastic. I feel like I learned a ton, and I've renewed some interest personally in Wenmoon, perfect, in this protocol. Really appreciate you coming by, and would love to have you stop by again sometime soon.
Again, Stephen, thank you a lot for having me on. I think it was really fun, and thank you everyone else for joining. Take it easy, guys.
And have a wonderful rest of your day.